Good afternoon, everybody, and welcome back to the weekly market analysis for the week ending April 6th, 2023. We are through the first week of April, first week of Q2 of 2023. Coming at you here on Friday. Obviously, the US markets are closed today for Good Friday. If you are celebrating this weekend, the Easter holiday, then have a blessed weekend. And for the rest of you, I hope you have a good weekend as well. And I just want to take a minute to remind you to hit that like button and subscribe to the channel if you're not already. And you can also find me on Twitter at Mr. J. Thomason. And you can also subscribe to my free weekly newsletter on Substack at befinanciallyfree.substack.com. You can find the links to both of those in the description of the video below. And we've got today some high impact economic news that hit the tape, and it was the non-farm payrolls report. A lot of people making a really big deal out of the fact that the payrolls got released on a non-trading day, which is interesting, but nevertheless, it doesn't really matter. Markets, the futures markets were sort of open, but they're not anymore. Bitcoin and crypto is open. We'll take a look at those in just a second. But today for our video, the question I'm asking is this just a pause in the bull market or in the new rally, or is this the point where we're getting ready to roll over? And I have a couple of thoughts about that. We'll take a look at some data as well. And so let's just jump right into it. So just taking a look at where we are in markets, obviously we have the S&P 500 sitting here at 4141.50 in the S&P futures, and still have not yet made a higher high than our February high. And actually what I've done is I've drawn a because of the way that I do my rules, my personal rules for technical analysis. So we had obviously a trend line that was something like, let me just try to do this really quick. We had a trend line that was something like that. And then when the trend line broke, these types of trend lines have broken multiple times during this bear market. And every time it breaks to the upside and then makes a lower low, then you would take, you can follow, if you follow on my screen, you could see this is the first place it happens. So then you would take it and draw it there. And had we made a lower low, we probably would have put it on the top of this wick or on the top of this wick. So if price does indeed make a lower low than our October and September lows from last year, then we'll obviously move the trend line again. But in any case, because it broke, we're trying to find structure of the markets now. And so what I've done is I've drawn a line from the August high of last year to February's high. And you can see that on the recent move to the upside, we've got a wick into that level. And so for right now, the market is respecting that. And then we've got some light support here, this horizontal level, which comes from the December, one of the December peaks, the closing peak, I should say, which kind of held as a little bit of resistance at the end of January, was support in February, broke down, was some resistance in March on a couple of occasions, and then we broke above. You can actually see, if you zoom in a little bit more, that we actually came down and tested that area. And what's kind of interesting about that line is, you could pull that line back and you could say that it was support on a couple of other occasions or resistance on a couple of occasions. But suffice to say, it looks like we're kind of pinned right in between these two levels, looking for direction. Obviously, with the markets being closed today on a high impact news event, the markets may or may not have moved drastically to the upside or to the downside on these developments. I don't really have a bias, but it definitely would have been interesting to see, what would have happened because of the impact of zero DTE options these days. It would have been interesting. Well, now it's going to be interesting to see what happens when trading opens in the futures on Sunday night, and then when the markets open on Monday morning, to see what direction they take. But in any case, that's kind of the levels that we are looking at here. The next area above that would provide some pretty significant resistance would be about 4,300, which is right around the place of the August high. and the area of probably the area of best support would be around a little under 3,900 to the downside. Maybe this level at about 40.50 that we've passed over. On the NASDAQ, we've got obviously we did make a higher high. I've been watching kind of this ascending wedge pattern. Just I'm not banking on it, but it is something I'm trying to be aware of just in case. And theoretically, you could see the markets continue up and kind of get kind of up close to that August high, which is coming in at about 13,673 or so before coming down and then testing. But I do want to call out that we did come back down and support or test this level at 12,942, which had previously been a resistance level that I was watching for a period of time. We got bounced off of that in early February, and we were getting rejected off that level in mid to late March. So I wondered if that would hold on the Nasdaq, but it hasn't. Obviously, you can see these the tide line, my tide line, and the kind of the faded control line are really moving up in light of the Nasdaq's recent price action. I do want to be aware, similar to kind of the S&P 500, you've got kind of an area of local support. I would say that this is a pretty strong level at 12,942. Just given that it has been support and resistance at multiple points over the previous year, and I would say that we have a pretty strong level just above. I think right now you have to go with the bias to the upside. There is just a ton of momentum in the Nasdaq, and because the Nasdaq underperformed the rest of the markets, down more than 30% over the course of the 2022 bear market. It makes sense that there's some rotation into this sector over the last few months, and obviously with the changes in liquidity on the Fed's balance sheet, that has much has been made of that over the last couple of weeks. Obviously, it makes sense that people believe in the tech trade again, as it was the most hated sector for some time, and now we have a similar. People believe we have a similar kind of setup with liquidity provision as we had post COVID in March 2020 and following into that year. So it makes sense, and it's hard to see without some more technical breakdowns. It's hard to see this thing really moving to the downside with any vigor. And even so, you'd want to see that this 12,000 level broken to the downside before you start saying the momentum is back to the downside. We still have a lot of room that we could pull back on and still maintain upward momentum. So that is something that you want to be aware of. And then the Russell has been the laggard. Much has been said about the fact that the Russell is probably lagging because there are a lot of regional bank stocks in the Russell. So that is something to be aware of. But I have been concerned for some time at the underperformance of the Russell. Very similar to I would call this out a lot if you followed this channel back in 2021. I would call out the sideways action on the Russell and say that it was concerning that the Russell wasn't moving to the upside in conjunction with the other indices, and that ended up being a sign of things to come. And so obviously these things can take time to develop, and you don't want to just start taking massive short positions. You have to let these things play out and respect, as Darius Dale would say, respect the x-axis. In other words, respect time. There's a lot of stuff that can happen, and it can take a lot of time to unfold. So you just want to be aware of that. The DXY obviously has come back down and gotten near its lows from February, from the very beginning of February. Previously, I drew this line that this would be a level I would want to see broken and stay broken, and we popped below it and then came back up. Right now, I would say the dollar is the most hated, one of the most hated assets, along with I wouldn't say yields are hated. I would say that. I wouldn't say that the bonds are hated. I would say the bond yields are hated as well. I'll get to that in a second. But you do see here that we came above that level. This is going to be really important if we break down below here and we get close to that 100 level. then that's going to be a signal that the dollar bear trade is going to be on, and that's going to continue. Obviously, when the markets aren't really trading today, I mean, currencies are trading, but because everything is kind of muted for the holiday, there's not really much that we could take from what's going on today. Um, so in any case, the with the tide line being bearish, showing that red, and it being pointed down along with the control line, um, definitely the momentum is to the downside, and you don't want to try to be a hero here and take longs. Trying to find the bottom, as they say, it's really hard to catch a falling knife. So um, quickly, the yields on the news today, the yield bounced back up. I do want to call out this trend line. I'll point out in a second, but we got a big bounce in the yields today based on the payrolls report. Along with that, I actually don't have the page up, but the rate hike odds are now pricing over nearly a 70% chance of another 25 basis points in the May FOMC meeting, and obviously that's a lot to do with the fact that the payrolls report has kind of suggested that there still is strength in the economy, that we're not really seeing that doomsday. Things are breaking, and the Fed is going to need to pivot and cut, or pause and then cut after that. So we still have CPI next Wednesday, so we do want to be aware of that. You can see gold here has careened to the upside. And I actually think that a lot of people looking for this to get up to the all-time high and maybe sit underneath that. I'm actually looking for this to pull back to around the 1900 level. We'll see. That's kind of the level that I'm looking at. It's really interesting to see gold move this way, because gold either typically moves on growth fear, so recession fear, or on liquidity and the real yield. And so I think that's going to be something to pay attention to. I just have thought it's been interesting to see gold bid when a lot of the other markets are trading as if we were going to be in a similar late 2020, early 2021 sort of regime. So I think that gold trading like this is very odd. But we'll see what happens. Like I said, I am expecting a pullback to close to the 1900 level. We'll see. We'll see if we get there. And then the crude oil. Oh, I'm sorry, I forgot to talk about something. This trend line on the yield. I've over the period of time in which yields have been coming up since 2020. I've been drawing some different kinds of trend lines, and the prime trend line, which is the main trend line, is not in any jeopardy of being broken right now. There's a lot that the yield could come off and still maintain the upside trend. But we've had this other trend line that it's only got 2 touches, but it still works for right now. And we came down and we tested that a couple of times, and then we broke down earlier this week on it. And then it's interesting to see that on today's price action, the yield came up and basically kissed that trend line. So what'll be interesting to me is to see if we see a follow through back to the upside, kind of a fake breakdown, or if this ends up getting rejected here and moves back down. I think a rejection here would probably bring us down to test the somewhere between 260 and 280, 2.6 and 2.8% on the yield. That would be my guess in the coming months. What is interesting, though, here that I also wanted to point out is to see that the tide line is above the control line, although that is closing, and we are getting kind of to the closest point since back in 2021 on that long consolidation, which basically took the better part of 9 months. So this can consolidate for a while and still move back to the upside. And I think the consensus is that the yield is peaked and that that this is gonna roll over. And that's entirely possible, but there are a couple of views out there that believe that the yield is actually going to move back to the upside. I don't really have a thought there, but I think a lot of people, because of the way that 2020 was. I think that people believe that if yields fall, then that means stocks must go up, and that's not necessarily true. Nor is it true that just because yields go up, that stocks must come down. So I think that one of the things that's changing here in 2023 is that bonds are going back to kind of the flight to safety perspective that has been typical of bonds over the years, because 2020 was very strange in that the bonds didn't perform as flight to safety even in the midst of a major stock market correction. So I do want to call that out. Crude oil, we gapped up real big on Monday following the OPEC plus production cuts. We are still below a pretty significant, I got to turn this red. We are still below a pretty significant resistance level at 81.90, approximately $82. So we'll be looking to see if we can break that to the upside. If you were interested in taking shorts, maybe if you're this is kind of like a buy the rumor, sell the news sort of a thing, then your opportunity would be right here for the most clean. If you think back to, again, I have these rules where I look at things based on where the tide line is in relation to the control line, and then where price is in relation to both of those. And you can see that these two occasions were really good occasions to back in October and November of 2022. Those were great occasions to sell crude. And so based on those rules, this would be an excellent place with clear levels. I can't point out a more clear level to you that you're wrong. If this thing gets above 82, 83, that would be the place to get out because you're wrong. But otherwise, if this moves to the downside again, if a recession comes, or if the markets begin pricing a recession more clearly, then you might actually see this turn to the downside. That would be a great trade. But of course, that's not financial advice. Do this at your own risk. But that's something that I would be watching out for. And then Bitcoin trading still on the weekend, even though it's a holiday. It is concerning that I'm starting to see a couple of these red candles that's showing you that the near-term momentum is turning back to the downside potentially. But obviously, medium-term momentum is to the upside. The tide line is up above the control line, so definitely don't want to just start shorting. I would reckon that at some point price is going to come back and touch that tide line. But with Bitcoin, it's a little bit different because the asset just moves unlike most other assets. But if you can look to the downside, during the bear market, and you see that while price gets away for a little bit, it does end up usually coming back and touching the tide line at some point. And you can follow that on the upside as well. If you just go to see 2020, you can kind of see into 2021. It takes a while for it to come back, but you do eventually see that come back. A really solid way to understand this one is to go back to the 2017 bull market. And you can kind of see as I just go along here that price does tend eventually to come back to that tide line. And so having said that, if we do get outside of a credit event, if we do get a pullback to this tide line, that is going to be a great opportunity to buy, just as this one was. The only difference here is that for those of you paying attention right here, the only difference is that, and I actually called this out and talked about this in my newsletter and in my videos, that right there, you don't see a cross yet. There is not a cross until the next week after. And so the problem is that there was no guarantee here with all the uncertainty. There was no guarantee here that this was going to move back to the upside, or that this was the ideal place to buy. Of course, then you can find those exhaustion signals, and that kind of sometimes tells you, hey, you should buy this. And so that's something that you want to be aware of. But if you're following a rules-based system, then you can't make that discretionary choice. You have to follow the rules. So Anyway, like I said, I am a little bit worried. We had the two exhaustion overbought signals, and then we've started collecting some red candles here. So I would anticipate that this is going to probably come back, and it's probably going to test, I would say, probably about 25,000. And then aside from a credit event or some other major sell-off happening for some reason, that's where I would say is the next, probably the next best entry point to the upside. And of course, if we come back to 25,000, everyone is going to, well, a lot of people are going to start saying, "Oh, see, here we go. We're headed back down to 20 or to 16 or whatever." So uh, those are the levels that I'm seeing right now. Quick check in on the VIX volatility for a little bit, and then we've just come right back down. And again, like, this is largely, I think, there's been a lot of people covering this. This is the zero DTE thing. Really suppressing 30-day volatility in favor of the more of the near-term volatility. You might notice that the euro dollar December contract is it's not falling. It's coming back up. Right now, this is showing us that we would be seeing 25 to 50 basis points of cuts by the end of the year. That's what the euro dollar contract is suggesting now. The 3-month bond yield is something I like to watch because in real time it gives you a sense of, if what should the Fed funds rate be right now. The 3-month bond follows that really closely. So it was really interesting on these red days. I actually was thinking, wow, the Fed may pause at that March meeting, but it ended up coming back up just in time. But the 3-month is the best signal to know what the Fed is doing. So if this gets back above the 5 level, then you could bet your bottom dollar that the Fed will hike another 25. The market doesn't want that. The market doesn't think that that's what should be, but that's probably what's actually going to happen. And part of the reason for that, and I'm going to shift over here really quick, is because the non-farm payrolls data, there is softening. You actually see this in the you could see this in the initial claims, which I've talked about on my Twitter feed. But non-farm payrolls report does show softening, but not to the extent necessary for a pause yet. So if you look on the kind of this first panel on the left side, you can see I'm tracking the establishment non-farm payrolls data. Our average pre-COVID trend was a little under 200,000. And obviously, anytime we come in above that, that shows that the market's good. The job market's at least strong according to the establishment survey. We are down from last month, but this 236K was above consensus estimate for, I think, what is this, 11 or 12 months in a row, which is a record. So that's interesting. And then we also have the household data on employed, and this is one of the things that the NBER uses to show whether or not recessions are happening. And basically, you'll see the green bar, which is the current, is up really high. And in order to calculate this, because the employed household data shows total employed in the time series. And so what I do is I take the change, the month over month change, because that's what the establishment survey or the establishment data is showing you. I take the month over month change, which is very, very volatile, and something that like Zero Hedge and others will point to and say, oh, well, the household survey says that only 100,000 or only 50,000 were added, or in some cases you've seen in recent months that like Zero Hedge will post, the household data says that we lost jobs, and so it can be super volatile. I had it plotted one time, but on a chart, but I don't have that right now. But you would see this number go up, and then way down, and way up, and way down on a month by month basis. And so, what I do is I take that monthly change, and then I take a 6-month trailing average, and so that kind of smooths that data out a little bit. But even so, in this case, as you can see, last month's reading was 227,000, and this month's reading is 340,000. And that's because the data today that was released showed that it was over 500,000 that changed from last month in terms of the household employed data. So super volatile, but it does kind of show that we're not at any particular point where the Fed has the ability to pause, and you can kind of see on the right panel that the you have two sets of bars, one of which is you can't really even see it. It's the private sector average weekly hours. It's not really changing. It changes a tad, but not enough, not substantially enough to make a huge difference. And then private sector average hourly earnings, though it is coming down on a rate of change basis, is still above the pre-COVID trend. And one of the things I keep calling out is that Powell, in his remarks for months now, has continued to say that we need a sustained period of below trend growth. And this is none of this is a sustained period of below trend growth. And I'm going to keep calling that out and keep calling that out. And the reason why that's important, a lot of people are saying, well, hey, this data is lagging or coincident. And that's true, but the problem is if you look at like unemployment being at record lows, a point that I call out here, the Fed looks at coincident and lagging indicators and they use these to inform policy. They can't make a decision, a policy decision based on what could come in an uncertain future. And that's something that a lot of people are beating their heads against the side of a wall because they keep saying, "Oh, but the indicators are showing that a recession is coming, or indicators are showing that things are falling off a cliff." And it's like, well, no, not if you look at the coincident and lagging indicators that the Fed is looking at, like the unemployment rate. We're still at historically low levels. Now, everyone will tell you, "Hey, these levels are almost always at their lowest right before a recession." And yes, that's true. Just look at, what happened in 2019, 2020, right? But what you don't see, what you're not seeing is an acceleration of this move to the upside. I mean, if you look at just the recessions that are shown in this chart from the St. Louis Fed, these shaded areas, which are the recessions, you have to remember they don't suddenly shade them at random and say, oh, the recession has started now. The NBER will retroactively look at various indicators and then say, oh, the recession started at X time. And what I want to call out here is that both in the recession of 2001 and then the 2008 recession, what you notice is that the trend is already accelerating to the upside before the shaded box even starts, right? So then what that means is you get into the shaded box where where it's accelerating already pretty substantially to the upside before the NBER even goes and says, yeah, you know what, this is a recession. We're not even seeing anything. If you look to the far right side of that chart, we're not seeing anything resembling that kind of a acceleration to the upside in unemployment rate. So this matters because the Fed is not going to make a policy decision about what might come. In fact, Powell has been pretty clear that, when they look at that they have learned from the mistakes of the past. Well, what are the mistakes of the past? Let me go to this Fred chart here really quick. The mistakes of the past, if you go to the 1970s, and you think about like the mistake they made in the past was that they let their foot off the gas pedal, right? And they even did that in the 80s under Volcker. Remember, Volcker raised interest rates, then the economy slowed down, and then he cut rates, and then he had to kick rates back up once again, which is why you get this kind of these two recessions in 80 and then in 81, 82. You just see this pattern. This is the pattern that Powell has said that he is learning from. I mean, this is looking through the lens of the unemployment rate, but it still matters because point is that the Fed can't make policy decisions about what might happen in the future. They can only make decisions based on what is or what has been. And so with that being said, you can, if you are looking at, I know I don't have an updated thing here on my ISM data, but But if you look here at the ISM data, so we saw again, like reductions on the manufacturing PMI data pretty substantially, like everything is in contraction. But ISM services is still in expansion. And even though all the numbers have come down, this is still expansion. And so we're not seeing anything materially deteriorating in such a way that suggests that the Fed has got to change anything right now. And the banking issues notwithstanding, those things, they believe that they have those things contained. They believe that they have been able to provide liquidity to stave off a crisis. And if that's the case, then there's, inflation is still really high. Um, and there's no reason for them to take in their minds, I'm not saying my opinion, but in their minds, there's no reason to take their foot off the brake. So I think you have to be aware of those kinds of things. And so as we think about, where the markets are right now with the, S&P at 4141 and the NASDAQ at 13184, like these are not, I mean, and people aping into, crypto again and all that. Like this is not the time where you should be banking on a Fed pivot when things are not broken. At least the data hasn't shown, you may argue things are broken, but the data is not actually showing anything broken right now. So if the data that the Fed is looking at doesn't show anything broken, and if the markets are still, like if financial conditions are still relatively loose, and if there are still people out there aping into, let me just see. I'm trying to do this in real time. Maybe I should have had this up already, but there is. Oh, what did I see? Oh, here we go. I saw this tweet. Where there's a dude who's talking about some coin, some speculative coin that is in a sideways triangle pattern, and they think it's going to go up to. It's currently at 120, and they think it's going to go up to like 11,000 or something like that, or 12,000. So like things like that, when you've got that kind of rampant speculation out there and financial conditions are pretty loose and volatility, like the VIX is below 20, and the data is not showing signs of breakage yet, like this is not the time to buy into Fed pivot talk. It's just not going to happen yet. Unless something substantially changes in the data before the May Fed meeting, we're looking at getting everything tightened. We're looking at getting the screws tightened a little bit more. And I'm not sure if asset markets are ready for that. So, like near term, obviously, right now, it appears the momentum is to the upside, and there's no reason to think that in the near term that these technicals and that this near term momentum is not going to continue to allow markets to push a little bit more to the upside. But this is not a new bull market. This is not a new bull market. And the data shows that things are strong enough still where the Fed is going to continue to tighten. And then ultimately that long and variable lag of monetary policy is going to have an impact. And then that's actually probably eventually going to cause more damage than would have been done already if the Fed had already paused. So you got to be really careful. I don't think I'm saying anything much different than other, analysts are talking about, but it's something you have to be aware of, be prepared for. So with that, that's it for this week. Again, don't forget to like and subscribe and share. And I hope you guys have a fantastic weekend, and I will see you guys next time.